morning, Amyr.
Good morning, Simon. How are you?
Very well, thank you. Very well indeed. So today we're having, it's an interesting chat, isn't it? Active versus passive.
Absolutely.
Which we get asked all the time.
Every single time, Simon.
What's your first reaction when I say what's best, Amyr? Active or passive?
It's a really interesting one, and I hope that our viewers here today will get a lot out of this chat, because the interesting thing is that we as financial planners, we look at that question of active versus passive in a much wider manner than what we see the retail press, for example, talking about. So I think today, Simon, is a chance for you and I just to go into the weeds of this subject.
Yes.
and then bring it back to why it's not as simple as just saying passive and active, because the initial answer to it is, one, it's a lot more complicated than just passive versus active, and two, that might not be the thing that actually matters.
No, it's context, isn't it? It's context, it's priorities, it's looking at the bigger picture, and actually we could spend hours discussing this subject, and there's a plethora of academic research out there, so we're not going to go down that road. We're not going to go down there at all, but let's put things in context. Now, I was reminded of a couple of quotes, and I think it puts it in some very interesting context. So if you don't mind, I will share my screen. And if people don't know, these were two government-sponsored reports: the Poor Miners Report from 2001 and the Ron Sandler report in 2002. And just for dramatic effect, I'm going to read them out. Institutional investors may be devoting insufficient resources to asset allocation, which may contribute to the majority of their investment performance. The second one, for the individual investor, the asset allocation decision is by far the most important factor in determining returns. Now, what do we mean by that?
I mean, this is huge, isn't it, Simon? Firstly, and I know this is almost patronizing, but I just want to focus on one thing. I would like the viewers to just have a little think about the dates of those reports.
Yes.
We're talking about the fact that the powers at be in these particular part of the government that looks at these things, and financial planners, we've been thinking about this for decades. Literally decades.
Yeah.
And I cannot remember the last time that I saw an article from one of the broadsheet papers stating as clearly and as succinctly just how important asset allocation is.
Indeed.
And what we've been seeing, unfortunately, instead is sometimes stories around, on the institutional side, these star fund managers falling onto their own sword by not paying attention to asset allocation. And on the individual investor side of things, we're seeing this consistent chase of the thing that was hot yesterday. Again, completely ignoring all of the academic studies around the fact that actually it's the way you allocate assets between the different asset classes that contributes to the majority of the investment performance that you will get.
Exactly. It's the majority of the return. So let's put that in context. Let's just flip straight away to the next slides, because there may be some viewers out there who actually don't know what we mean by assets. Now, I'm going to concentrate on a moment for the four basic asset classes. Now, for the purposes of this conversation, we are going to ignore the other two, which are commodities, including sort of gold and platinum and what have you, and collectibles, anything from racehorses through to fine art. So we're looking at the four basic asset classes. We've got cash, fixed interest, company shares, and commercial property. And it's the combination, it's how we mix these four asset classes together, what proportion and geographically how we spread them, that produces the majority of the performance. Not which fund manager.
Also, yeah,
please go ahead.
Apologies for butting in, Simon. I was going to say, and also to go back to something you said at the top of this video, and also how each of those asset classes serve the financial plan. Why would you have a proportion of cash? Why would you have a proportion of fixed interest? Why would you have a proportion of stocks and shares? There's a why behind that. And that why, the answer to that why, is driven by the financial planning requirements that a particular client has. It's not because of my ego or your ego or anybody else's ego. there is a need for that asset class, if there is a need, and therefore you need to populate it accordingly.
Absolutely. So let's just scroll on if we can for a moment as we're talking about this subject, because this is an academic study going back to 1987, and this was kind of the seminal work, wasn't it? It's been repeated a number of times, probably most recently by Farmer and French, but this is going back to 1987, where effectively these academics looked at, I can't remember the exact number, I think it's like 2,500 actively managed funds. In essence, the study looked at the difference in performance. They were trying to determine why some of these actively managed funds had done staggeringly well, right through to why some had done really rather poorly. And actually, when it came down to it, 91.5% in this particular study came down to asset allocation. And as you can see, just a small amount, just over 2% and just under 2% came down to individual investment selection and market timing.
Which is incredible, right, Simon? I mean, this is, again, it's been, so firstly, this study was done many decades ago. And secondly, it has been empirically retested for all of these decades since then until now, through various different academic studies, all of them freely available to the viewers to Google and find from the likes of Yale, Chicago Business School, Oxford University, etc., etc. The Cass Business School has done quite a lot of studies around this as well, freely available. All you need to do is Google this sort of stuff. And what you're seeing here is the empirical evidence that there is no consistency, or at least no evidence that anyone is that good at individual stock selection, that is the thing that you should be trying to find out there in the market. It's the opposite. It's the fact that the reality is that asset allocation is how those assets are distributed among equities, stocks and shares, amongst fixed interest. That's the driver of your return. Not whether the particular star fund manager or the team of managers or whatever idea that particular manager is coming up with, not whether that is the thing that drives the performance or not. That's more linked, unfortunately, to something called luck. And, you know, prudent investors, they don't bet their financial well-being and the financial well-being on their family on trying to find somebody that will be lucky with their investment decisions.
Indeed, often it can come down to what we would call maybe chimpanzees playing darts principle, which is if you have a group, in theory anyway, chimpanzees who could play darts, one of them would win. Now, would that same chimpanzee consistently win? And unless he won consistently, you then wouldn't know whether or not the win came from luck or from skill. It's only consistent long-term returns that can demonstrate anything other than luck. So, absolutely. Moving on, this is just move us around a little bit. This was just a very simple principle. I think I can find a space for us down here. And the old iceberg, and it's one picture, it's better than 1,000 words, because if you are a fund manager and if you are trying to beat the market and you're doing so either via individual stock selection and or market timing, you need to buy and sell. And you need to buy and sell on a pretty regular basis. And as we know, firstly, that trading requires a fair amount of research. And so the fund itself is already laden with higher management fees. But on top of that, every time a fund is traded, then we can have stockbroker fees, trading commissions, what are called bid to ask spreads. Every time you buy a share, it has what's called market impact. And so when looking at funds, you can actually, if you can drill down far enough, you can actually find what's called a portfolio turnover rate, which is the percentage of the fund that is basically swapped on an annualized basis. And this, again, is just a drag on performance. The higher the charges.
Simon, this is part of the analysis that we do for our prospective clients when they're they're instructing us to build their financial plan, to analyze their current investments, and then to perhaps recommend any changes to their investments to suit the plan in a better way going forward, especially when it comes to retirement planning, retirement income planning. And Simon, this is the going into the weeds. I mean, you and I could share some horror stories of portfolios that a prospective client has bought on a DIY basis, just following the tips from the papers or what have you, where the portfolio turnover, or in plain English, the churn of stocks and shares and of assets within a portfolio, is close to 100%. In other words, imagine the underlying additional costs that your fund manager is generating without asking you. That's the bit underneath the water. That's the bit of the iceberg underneath the water that you're not seeing, just by virtue of the amount of trading they're doing inside the portfolio. And we have independent tools which we pay licenses for, that allow us to look at that. They allow us to look at the cost, the additional cost that fund managers are incurring and are passing on to, in an invisible way almost, to the investor by their behavior inside the fund. And some of it is staggering.
Indeed. And this just brings on to a lag in performance, which we can, I think the final slide we have for today, and once again, I might just have to move us around a little bit, so I might have to learn going forwards about slides and where to position our photos. But this is an ongoing survey. Now, this is from the States, but actually it's no different in the UK. It just happens in the States, they generally have better academic research when it comes to these things. But this looked at funds from 2000 to 2019. In fact, I think fairly soon, over the next month or so, we should get the updated stats for last year, bring up to 2020. But what this is telling us is that of equity funds, at the beginning of the study, there were 2,758. And by 2019, there are only 41% survivors. Now, generally speaking, is it fair to say that if you have a star fund and a star fund manager, that it doesn't disappear? Is it fair to say, Amyr, that if it's doing well, they keep it going?
I think that would be fair to say.
The other issue you could argue is that if the fund isn't terribly good, doesn't perform terribly well, that what generally happens is these funds are merged together, or the fund is simply well, I think merging is what they generally do. It's very rare that they disband the fund altogether. So in this case, what we're suggesting is there is a survivorship bias, meaning that only 41% of the funds have survived. And of that, there are only 22 winners. 22% are winners, meaning that pretty much if you were gambling at outset, you would lose on 78% of occasions with those fund managers. Absolutely.
Imagine having to withstand that burden when it comes to your retirement planning. That's what I would ask our viewers to think about. If you're DIYing your investment selection based on noise or news, however you want to read it, that's out there in the press, not only do you need to at outset be able to pick funds that over the long term, this is a 19-year period, right? Retirement today can be a 30-year period. Imagine having to upfront pick funds that are actually going to be around without merging with others, number one. And then number two, out of those, also having and being lucky enough, because there's no other word for it, picking the ones that not only are going to be around, but that are actually going to deliver performance over and above what a basic passive tracker would have delivered. And by no means this is suggesting that one should just passively track the market. That has its own downsides as well.
Yes, it does.
What we're saying here is that the conversation around passive versus active is nuanced. And hopefully the viewers are starting to see that there are things that are more important than this that should be answered beforehand. In other words, your financial plan, what requirement do you have for stocks and shares, for bonds and fixed interest, and for, say, cash? What requirement does the plan have for it to even be sustainable? Once you've realized that, then you can think, okay, how am I going to populate my plan with the correct investment philosophy so I have enough stocks and shares, enough bonds, and enough cash to have a sustainable journey in retirement? And then you get to the point where you start thinking, well, what are the fund managers out there that can provide me a systematic way of investing they're not just making active bets, because now I understand that just creates additional costs in a portfolio, and it hasn't proven to beat the market over time. And equally, they're not just passively tracking the market, because whilst you're doing that, every single hedge fund in the world is arbitraging against your strategy. So you really only get to the point of, what managers do I use, after you've answered all of the questions above that. And again, for the viewers that are DIYing and are interested to know more, that's where the likes of myself and Simon can help.
Do you know what, Amyr? I'm not going to add anything else to that. I'm going to close down those slides. I'm going to say thank you very much. It's been a pleasure talking to you today. And once again, when we start one of these recordings, there's just so much we could talk about. And we just need to stop and say, okay, we'll come back and we'll continue this conversation at a later date. So thank you very much, Amyr.
Absolutely. Thank you.